Welcome to Ilagan Whiteboard Friday, where we look at complex legal and compliance issues in a simple to do ways. This series is brought to you by Ilagan, your partner and provider of end-to-end business services.
Hello and welcome to Ilagan Whiteboard Fridays, where we look at various taxes and compliance related issues in a user-friendly fashion. Today we will look at a very hot topic as to why investors prefer investing only in private limited companies. Multiple reasons why investors prefer to invest in a private limited companies. First of all, let me tell you that investors don't invest in a company. It's more on the idea, the kind of ability that the whole execution team brings, the potential that they see and the kind of returns they expect to make in the whole deal. So don't think that if you just have a private limited you will be able to raise investment. So that's not the case. But in case if the investors agree to invest, then they would want you to be a private limited company, and these are some of the reasons why. Private limited companies have something called preferential shares and treatment. First of all, the share concept itself is not there in LLP. And in private limited you have multiple classes of shares. You can have equity, you can have preference and stuff like this. So investors generally want to go for a preferential shares because you get a preferential treatment, and then the event that the company is winding down or in the event of a liquidation, they get a preferential treatment and settlement of dues than the founders and stuff who are generally at a equity stake level. So that's one reason why investors want private limited. Then in private limited it is possible to move from one class of shares to other. So at the end, typically the investors, whenever they want, they can actually convert their preferential holding to equity holding or equity to preferential. So that conversion is possible from one state to another, and that's why that's the second reason. Now if you look at any investment that's generally been done, there are a couple things that investors want to make sure that you do that. One of them is shareholders agreement, which is very crucial because it covers things like rights of first refusal, drag along, tag along, who's responsible for what would happen in the case of IPO and stuff like that. So it's a very important document, and they would, during the due diligence, in case if you don't have an SHA, they would want you to, and they would make sure that you enter into a proper shareholders agreement. Then investors also give this a lot of valuation because employees are key to the success of any companies. So since so they want that you should allocate some pool of the shares to go to the employees, and that's one reason why they want private limited, because you don't have this concept of ESOP, shareholder agreement and stuff into an LLP. Valuation of shares is discrete. So that means, see, in a shares, whenever you are raising investment, say you are raising an investment of 5 crore, typically your authorized capital would be somewhere in the range of 1 to 5 lakh, 10 lakhs kind of thing. So where does the additional money go to? So the additional money goes as a premium on the shares of the company. So since there is shares, there is also possibility that you can charge premium on them. In LLP, you don't have that premium concept. So if you are bringing in 5 crore investment, the whole investment goes up by 5 crore. And for example, say the founders who had invested say 1 lakh rupees, so 2 lakh was the initial investment, and now investors are bringing in 5 crores. So then the ratio, you can just calculate how the contribution ratio looks like. Whereas in case of a private limited companies, it's more about the number of shares that you hold, not the amount of money that you have put in. So if you have put in say 1 lakh worth of shares, and then you can raise 5 crores by issuing just say 10,000 worth of shares. So your holding still remains very, very high, right? So that's where, which is good, because no sensible investors or investors generally don't prefer to take the majority stake into the business, because if the founders lose interest into the business, then the business runs a risk of getting closed or something. So that's why they also want that the founders hold majority shares until say certain round of funding and stuff happens. So that's where this point becomes very helpful. Now there are any investors typically no investors comes for a lifelong things, right? So they need to exit, and depending on their requirement, it could be anywhere between 1 to 5 years or 10 years. So they need to have the clear exit options in mind whenever they are entering into an investment agreement. So vesting schedule, it helps to prevent the uncontributed equity both from ESOPs or from founders and stuff. So suppose a founder quit after a year and he was promised a 30% stake in 4 years time. So the 30% does not get lost. So it's only say about 7.5% that is being issued to the founder for contributing only 1 year. So the remaining remains with the company. So that prevents undesired dilution of stakes for everyone. So that's why investors prefer this. Stake sale, since you have independent paper shares, you can actually do a part sale or complete sale to anybody. It's just like buying and selling shares on the stock exchange. So in private limited, you don't have stock exchanges, but the process is same of buying and selling. So it is possible, whereas in case of LLPs, when you are selling stake, complex laws of goodwill valuation and stuff comes in because you don't have those paper share concepts. So you don't have those premium and stuff. So whatever extra, say you invested 5 lakh and you are selling it for 1 crore, your contribution, then it's considered more as a goodwill sale, and that complex taxation issues come into picture. And yeah, IPO is a great point of exit for a lot of investors, at least the initial ones. So any investment agreements, if you look at, investors would always try to mention the roadmap till the IPO, not beyond that. So they want that the company should go into IPO, or they agree before making that investment, which is again possible only in private limited, not in case of LLPs. So that is another exit options, and that's why investors look for private limited. Fine gain controls. So most of the investors would not like to involve into day-to-day operations of the company, but at the same time maintain a strategic control and stuff onto the company's direction, where it is heading to, reviewing the progress and stuff. So they typically do it by taking a board observer seat into the board of directors. Now the whole concept of board and stuff does not exist in LLPs. So whereas here investors know that you get a board seat, so they will nominate maybe 1, 2, 3, depending on whatever is the whole deal, and they know that they can actually control. So in case if they don't like what founders are trying to do, and if legally needed, they can actually challenge those decisions or control those or stop those and things like that. So that's why you get a very good fine-grained control, not being an executive director kind of thing, but just by being into the board of directors, they get that. And then mandatory audit. So private limited accounts has to be audited mandatorily, irrespective of whatever shape you are in. Say you are a loss making, you are selling peanuts, or you are into multi-million and billions of business. Audit is mandatory. So that gives a lot of confidence and comfort factor into investors, that whatever is being done at the company level, because they are not involved into day-to-day activity, so are properly audited. So there is an external agency which audits all the things and makes sure all the compliances and stuff are in place. So these are few reasons why investors actually look for, like there are multiple more reasons, but these are the more important ones why investors prefer a private limited as regards to any other form of business like LLP, proprietorship or anything. So in case if you are planning to raise money or funding, then you should be aware of these points and then take a decision whether which business type would be good to start with. And you can always talk to an expert for getting more clarity onto various topics, and then take a decision accordingly. That's it on this. Feel free to drop us an email at support@elagan.com or check out our knowledge base at elagan.com/kb. And thanks for attending this Whiteboard Friday. Thanks for attending this Elagan Whiteboard Friday. Thank you.